Hey guys, so I am sharing with you today the people that I believe are the best bond fund managers in the world. Now, with the recent Fed rate cut, a lot of people are searching for yield, and if you are that type, if you're looking for fixed income, the company I'm talking about is Pimco. Not Pimco, Pimco. And they manage about 20 funds, and all they do essentially is bonds and all sorts of bonds, and they scour the world. They run actively managed closed-end funds, better known also as mutual funds, but they're closed-end. Your what that means is they IPO a certain amount of shares, and that's it. Now they can borrow money to boost the fund. That's one of the features of a closed-end fund. They are actively managed, so they manage the account. They can do all sorts of things. They can go all over the world. They're not set in stone by big big money managers saying that you can't do this or you can't do that. They can take risks. They can load up and borrow all kinds of money. They can borrow typically 30 to 40% of the asset value, and that is how they get your income up, because a lot of closed-end funds pay very good income, distribution income. And Pimco is one of the best at it. And what I'm going to do is go in here and look at a few of them. Let's see, we'll go here to sponsors. Oh, I'm on cefconnect.com. If you need to learn about closed-end funds, you need to go to this website, go to the Education Center, and learn all you can, because not all closed-end funds are created equal. Just because it has a high yield doesn't mean anything. Also, what you'll notice for a lot of these is extremely high expense ratios. Some as high as, I've seen them as high as 4%, and Pimco's no exception. But what that includes is the expense ratio, the expenses of the fund managers and the fund company, but it also includes the interest expense on the leverage or margin or loans that they take out to boost the return. So it's not like they're charging you an exorbitant amount in an expense ratio. Yes, it's high, but it could also include interest expense. So one of the top ones is Pimco. We'll just click on Pimco. They have 20 funds, and we'll view those funds. And we'll see, I almost guarantee you every single Pimco fund will trade at a premium. Now, what do I mean by that? Right here, discount and premium. Oh, there's one that's trading at a discount. Barely. But their most popular ones really trade at a premium, and they always do. They very rarely give you an opportunity to go in on them. And most of them all pay monthly income, and it's anywhere from 3.8% on up to 10.7%. Now, all these have different strategies. We'll just pick a couple. I think it was Dave that was asking me about PTY, so let's check out PTY. Just on this front page, you can see how much leverage it has. So it has 40% leverage. It pays a 8.4% distribution rate. Whoops. It pays it monthly, and it is trading at a premium of 12.44%. But I'll show you, it's probably right now, probably that's a good price to get in at. Let's check them out. So when you click on them, whoa, they actually they're giving a pretty decent entry point right now. And I'm going to explain this. So right now the current share price is $30.55. Their net asset value is $27.17. Now what does that mean? That means the value of everything that the fund is invested in. So the value per share of all the bonds that they're invested in is $27.17. The share price, which is decided upon by the market, not by the net asset value like an ETF. Most ETFs, for instance, like VOO, they trade at their net asset value. So if their net asset value of all 500 holdings, I'm just picking a number, is $300, the price for the ETF is going to be right there, within a couple of pennies, if not right on. The unique thing about closed-end funds is the share price is decided upon by shareholders. So, you know, if the demand for this drops on the sell side, wait, let me back that up. If people no longer want the shares, this price is going to go down because, you know, there's going to be buyers on the other side saying, wait a minute, you know, I want it cheaper then if you don't want it. It's all buy and sell. It's just like going to a market or a flea market. That's too simplified, but anyway. But the share price, $30.55. The net asset value is $27.17. So you're paying 12.44% to get access to the assets in this fund. Now, what do you get for that? Well, you get an 8.4% managed distribution of 22.05 cents a month each and every month. You get that. So when you're looking at CEFs or closed-end funds and you're looking for bonds, you want to buy these things as close to NAV or under as possible. So if this were trading at a discount and say the share price was $25, so you're basically, if this was $25, you'd be buying this for less than what the complete assets are of the fund. Does that make sense? So you're buying the assets at a discount to what they're valued at. But in this instance, you're paying more. Why are you paying more? Because Pimco is a extremely high quality bond fund manager, and they always trade. They have never traded at a discount. Look at the 52-week low right there. The 52-week low was a 9% premium. If you look at their since inception time, it gives you very rare times where the price is underneath the NAV. I wonder why. Oh, this is 52-week. You know, this looks like back in 2013 it was a extremely good time to get in, where the price was under $28 and the NAV was above, like, in the mid 30s. Most recently, December 2018, where NAV, the net asset value, and the price basically met. That gives you a perfect opportunity to buy in this fund. And I'm looking at now, because if you could see that line right there, that's a pretty big dip. And it looks like it was probably 30, yeah, the 32.35, and it's dipped down now. Well, it doesn't show that perfectly. It's dipped down to $30.55. Let's take a look. because sometimes this is off. So let's look at Yahoo Finance, and let's look at PTY. And okay, it is $30.55. Oh, see right there, it went down to $29.06 on February 28th. Recovered pretty hard, but it looks like it's still at a good discount. Well, it's not a discount, but it's one of these rare times where Pimco gives you a time to get in at a decent price. But the NAV is dropping a little bit. But if you look at this thing since inception, the net asset value. This is what you want to look at when looking at the quality of a fund. Look at their since inception date, and since their inception, their net asset value was $24, and it's gone up and down, but it's stayed level. Where we're at right now is at $27.17. That's the sign of a good, a well-managed fund, because a lot of these funds you'll pick up and it'll just be, you'll see this blue line which represents the NAV go from here and just fade away as they just keep eroding money. So that's why I say all closed-end funds aren't equal. I wonder if I can think of one that is a bad one. MLP closed-end funds probably is going to be ugly. So there you go. Look at this thing. Since inception, the net asset value is that blue line, and it was at, I mean, MLPs have been under pressure, but it started out at about $18 and it is now $5.58, and the price has tracked that quite nicely. What do you get for that? You get 11% distribution monthly, but with the net asset value of the fund constantly going down, it's not worth it. What you want to see is this: the net asset value either staying flat or growing slightly. And let's see if another one of Pimco's funds, if they're all like that. Let's check them out. Another popular one is PTY, if I can find it. That's a pretty young thing. Just kidding. That would be PYT for any of you Michael Jackson fans. Again, look at that. Big discount, trading at big premium, trading at a 20% premium, 8.9%, and trading monthly. And let's look at the net asset value here. Again, flat, just under $15, and it's still right there. So, even though they've dumped down, they've been able to recover. And if you look at these, another thing you look at on this website when you're researching closed-end funds, you go to the fund basics. It'll show you how much debt that it has. Like this one has 1.6, I think it's 1.1 billion, isn't that 1,000 million? $1 billion in debt. That doesn't seem right. Is that right? Yeah, that's right. Total investment exposure 2.6 billion. Total common assets 1.5 billion. And then you got leverage at 1 billion. So 40% of it is exposed to margin. You have 1.87% management fees, and you have 2% interest on the loans that they have. So if they can get, that's the thing, if they can get loans for 2% on their money and then turn around and get bonds or secured bonds at 8%, that's how they make their money. We'll go look at distributions. They paid a special distribution in last December. And one thing you want to look at here is where the distribution comes from, because it tells you the declared date, the payable date, the ex-dividend date, the distribution amount, and then where it comes from. So if it comes from income, that's usually dividends, or bonds aren't dividends, they're coupons or interest, either one of those. They can come from long gains, so that's if the fund holds a bond to maturity, and they get their, or no, sorry, a long gain would be if they held something longer than a year and they sold it, and that they haven't done that, they're holding on to their things. Their short gain would be something that would be, a short trade. They haven't done it, and you mostly won't get that in a bond fund. You're just going to get income. But sometimes you will get ROC, which is return of capital, and Pimco funds are pretty good at not returning your own capital. Return of capital isn't always bad, especially in equity funds, because a lot of times in equity funds, I really should just do a series of closed-end funds, because these are such complex animals that it's hard to get them all into one video, and this is probably already going on too long. You can go to performance and you can see that PTY has killed it pretty much every year since 2013. Down for this year. So could be a buying opportunity. I don't understand why, because usually, when the markets are going down, people flood to these income stocks, and I don't know, maybe I'm thinking about it wrong. Then over here is portfolio characteristics, where it'll show you what they're all invested in. A lot of this is, currency swaps or something like that. Weird stuff. They're getting 8.38% out of this, whatever that is. It's just, it's very interesting. Like I said, these bond fund managers can scour the world to find income producing funds for you, or bonds for you. And then you'll see bonds, what they're exposed to, 168%. The reason for that is because they're leveraged. So, and then you'll see 80% underneath in cash. That's because they're leveraged. Then it'll show you the credit rating. A lot of them will be not rated, or triple B or below. So they're in riskier bonds, but these guys have been doing it for years. So, and they're kind of in long bonds. Well, they're kind of not bad, because you got 1 to 3 year at 13%. This is the maturity of the bonds. So when the bond matures is when they get their money back. So they get 13%, 1 to 3, 3 to 5 years is 20%. So this is important because, when a bond matures, you get your money back. That's how bonds work. And then they can go out and find other opportunities. So they just keep recycling money. It's kind of how that works. And you can see here, United States, they're big in the United States. United Kingdom, they have some equity in here. Argentina, a little bit, 3%. Canada, 2.4%. And just little bits here and there. Ireland, Brazil, Spain, Netherlands, France, Mexico. I mean, they're everywhere. So I think I'm going to do a closed-end fund series, if you guys are interested in me doing that, because I can go through all the sectors. I could probably make videos on this thing for forever. You let me know. But if you're looking for income, is these things aren't for everybody. These closed-end funds aren't for everybody. If you're in the income phase, like when I retire, I will probably do a bunch of these and get this 8% yield, and I would probably trust Pimco with the money, to be honest with you. And if I could just survive on the distribution rate without touching the capital, that'd be awesome. So that's just a little overview I wanted to do to talk about closed-end funds, and Dave was asking me about PTY, so I thought I'd take a look at it and go over it a little bit. I think it's at a buying opportunity right now, to be honest with you. If I had some cash, I'd probably put it in there because, like I said, Pimco funds don't really give you an opportunity to get in. They normally go, this fund in particular normally goes for a 17.5% premium. Now, right now you can get it at about 12.5%, so not too shabby, not too shabby. Anyway, I know this went on long. If you like, please share, subscribe, comment down below. Love to see what you think, and we'll talk to you later. Thanks. Bye-bye.